Hi friends, my name is Ravishankar Raju. I am a Senior Manager Learning and Development and I have got 17 years of experience in the field of banking, finance and insurance sector. A new IC38 which is starting from April 2023 has got 3 sections. First section deals with common syllabus and second section deals with life insurance and third section deals with health insurance. So if you are watching my channel first time, please subscribe and press bell icon for my further videos. Let us start the session. Section 1, Common Syllabus. Introduction to Insurance. These events make people anxious and afraid. How can you protect our assets or ourselves? We can protect ourselves by having a system of sharing and mutual support. That is called insurance. What do you mean by the word insurance? An insurance is a legal agreement between an insurer and an insured in which an insured receives financial protection from an insurer for the losses he may suffer under specific circumstances. Let us look at the history of insurance. In ancient China, the Chinese traders used to export their goods to different countries in the world through big ships. Each ship is owned by each individual trader, but when they return back to Chinese shore, they may last few ships during the voyage due to many problems. The trader who has lost the ship become bankrupted, so they made a solution. Instead of sending one product in one ship that is owned by one individual trader, they have designed their ships in several compartments. Now, each ship has exported with different goods by different owners. If one ship lost, the loss would be shared to all. This solution made all the traders share the losses equally. This is called sharing of losses. Lloyd's Coffee House was a significant meeting place for ship owners, marine traders, and sailors in the 17th century in London. This led to the establishment of Lloyd's Insurance Company. When you get the question, what is the first insurance company in the world? You can answer Lloyd's Coffee House, which is also called Modern Commercial Insurance Company, started in London. History of insurance in India. The Oriental Life Insurance Company Limited started in 1818 at Calcutta. This is the first life insurance company in India. Triton Insurance Company Limited started in 1850. This is the first non-life insurance company limited in India. Bombay Mutual Assurance Society Limited started in 1870. This is the first life insurance company in India started by Indians. National Insurance Company started in 1906. Insurance Act 1938, which is very important for the insurance sector in India even today. Life Insurance Corporation of India started in 1956 after nationalization of insurance business in India. General Insurance Corporation started in 1972. The Malhotra Committee, set up by government in the year 1994, and it has recommended opening of the insurance market for the competition. Insurance Regulatory and Development Authority of India started in 2000. This is the Insurance Regulatory Authority for the Indian insurance sector. The concept of risk pooling. 1 lakh group of individuals. Suppose if they pay rupees 100 each, it will become 1 crore. If 10 people die each year, the insurer distributes the pool money to the families of 10 people. They pay 100 each, and if they die, their families will receive 10 lakh each. It is called risk pooling. Law of large numbers. More people, more the benefit. If 1 lakh people pay 100 each, then it will become 1 crore. Assume if there is no change in death rate. If 2 lakh people pay 100 each, then it will become 2 crores. Similarly, by 3 lakhs and 4 lakhs. More the people, more the benefits, more the advantage. This is called law of large numbers. Risk management techniques. Risk avoidance. Many times it's not possible to completely avoid risk, but the possibility should not be overlooked. For example, at the height of a thunderstorm, avoid traveling on road as it may lead to accidents. Risk retention. This can be practiced if the cost of insurance is more than the actual loss. Risk reduction. This strategy helps to reduce the severity of potential risk. Wearing seatbelt and having helmet while driving. Risk financing. This strategy can be used if one could able to manage their losses financially. Risk transfer. The best way of managing risk. Buy insurance and transfer your risk. Then insurance company provides financial protection to you and your assets. We have seen that risk transfer is the best way of managing risk. Buy insurance and transfer your risk. The core elements of insurance. Here, risk, peril, and hazard. Let us know about them more clearly. Uncertainty of occurrence of an event that can cause economic losses. For example, due to death, economic loss can happen. Due to accident, due to disease, all these things can cause economic losses. And peril, an event or situation or incident that can cause property damage or loss. For example, flood, earthquake, lightning. So all these things comes under peril. And hazard, any action or condition or habit or circumstances or situation that makes a peril more likely to occur or a loss. For example, smoking cigarette can cause cancer. Here, smoking cigarette is a hazard. Principles of insurance. These principles are very much important for running an insurance business. First principle, utmost good faith. It is also called Ubarima Fights. It is the name of a legal doctrine which governs insurance contracts. This means that all parties of an insurance contract must deal in good faith, making a full declaration of all material facts in the insurance proposal. Here, material facts means those facts which are required for the underwriter in fixing premium and in accepting risk. Here, you should also know the importance of section 45. It says that if any misrepresentation or concealment of an material facts either at the time of inception or at the time of revival of an insurance policy can lead to cancellation of policy benefits. Insurable interest. It is defined as the concern of an individual towards obtaining an insurance policy for an item for an individual against any type of unforeseen events such as losses or death. That is called insurable interest. In broadly speaking, it is all about legal and financial relationship. Here, who can have insurable interest? Self, spouse, parents of his minor children, partners, employee and employer, and keyman. In life insurance, insurable interest should be present at the time of taking the policy. In the general insurance, insurable interest should be present both at the time of taking the policy and at the time of claim. This is very important, you should remember it. Proximate cause. Mr. Pinto, while riding a horse, fell on the ground and had his leg broken. He was lying on the wet ground for a long time before he was taken to hospital. Because of lying on the wet ground, he had fever that developed into pneumonia, finally dying on this cause. What is the reason for his death? Though pneumonia might seem to be the immediate cause, in fact, it was the accident fall that emerged as the proximate cause, and the claim was paid under personal accident insurance. So, proximate cause means the active and efficient cause of events while brings about a result in settling a claim. Principle of indemnity. It is an insurance contract that compensates you for any damage, loss, or injury caused only to the extent of the loss incurred. For example, Ram has insured his house worth rupees 10 lakhs for the full amount. He suffered loss on account of fire estimated rupees 70,000. The insurance company would pay him an amount of rupees 70,000. The insured can claim no further amount. The philosophy is that one should not make a profit through insurance on one's assets and recover more than the loss. Usually, principle of indemnity is applicable to general insurance only. Indian Contract Act 1872. A contract is a valid agreement between two or more parties which is enforceable by law. There are 6 steps in this act. Like any other contract, insurance policy is also a contract. The first step is offer and acceptance. One party offers, the other party gives their acceptance unconditionally. You should remember the word unconditionally. And second step is consideration. In insurance policy, premium is the consideration. And the third one is agreement between parties. And in Latin language, agreement between parties can be called as consensus ad idem and free consent. When you are doing a contract, you should be free from certain issues. Capacity of the parties. People who are minor and mentally unsound minded people and criminals, they cannot enter into the contract because legally they are not eligible. And finally, legality. So, once again, check these points. In insurance contract, premium is the consideration. In Latin language, consensus ad idem means agreement between parties. Coercion means criminal behavior during the process of contract. Minors, criminals, and mentally unsound minded are not allowed into the contract. Underwriting is the process of determining whether a risk offered for insurance is acceptable and if so, at what rates, terms and conditions. Underwriting comprises the following steps. First, assessment and evaluation of hazard and risk in terms of frequency and severity of loss. Formulation of policy coverage and terms and conditions. And fixing of rates of premium. Sources of information. Underwriter will get the information mainly from proposal form, risk surveys, and historic claim experience data. And as a customer, we need to submit KYC documents. We have got two kinds of KYC documents. So one is standard age proof and another one is non-standard age proof. So in standard age proofs, you can see school or college certificate, birth certificate, extract from municipal record, passport, PAN card, service register, identity card in case of defense personnel, marriage certificate issued by appropriate authority. When it comes to non-standard age proof, horoscope, ration card, an affidavit by way of self-declaration and certificate from village panchayat. Grievances redressal mechanism. Whenever customer gets a problem with insurance company, he may approach different entities. First one he may approach is IGMS. IGMS was called as Integrated Grievances Management System, but currently it is changed to Bima Bharosa Grievances Management System. It is an online consumer complaints registration system created by IRDAI. You can make best use of this system by giving accurate information about your complaint like the policy number, name of the insurer, and your contact details. Policyholder can approach the respective insurer first for any grievances. If he does not receive any response from the insurer, or if the response or resolution received is not to his satisfaction, he can approach the regulator under the IGMS. Ombudsman. The Insurance Ombudsman was created by the Government of India for individual policyholders to have their complaints settled out of the court system in a cost-effective, efficient and impartial way. The Ombudsman will make his recommendations with 1 month of the receipt of the complaint. The Ombudsman will pass an award to insured which he thinks is fair within a period of 3 months from the date of receipt of all requirements. The complaint must be logged within a year of the events mentioned. A policyholder can also approach Consumer Forum. He has got 2 years time to reach Consumer Forum. There are 3 levels. The first one, District Consumer Disputes Redressal Commission. Value of the goods or services does not exceed rupees 1 crore. The District Commission has the power of a civil court. Next, State Consumer Dispute Redressal Commission. Value of goods, services and compensation if any claimed exceeds rupees 1 crore but does not exceed rupees 10 crores. National Consumer Disputes Redressal Commission. Value of goods, services and the compensation claimed exceeds rupees 10 crores established by central government. Code of conduct of an agent. Giving necessary information about the insurance product offered for sale by his insurer and consider the needs of the prospect. Disclosing the scale of commission in respect of the insurance product offered for sale. Obtaining the requisite documents at the time of filling the proposal form. Assisting one's customers or policyholders, claimants, beneficiaries in claim settlement related procedures. Explaining to the prospect the nature of information required in the proposal form by the insurer. Let us start with the section 2, life. What life insurance involves. To know this more clearly, I will explain you a story. Mr. Kiran is a software engineer. He has got a beautiful family. His wife is a homemaker and he has got two kids studying in a reputed school. He is the only breadwinner of the family. He protects his family's needs with his income. He bought a nice house recently with a loan and he has owned a nice car also. Life is going very nice, but as we all know, life is full of uncertainties. One day, Mr. Kiran has had a massive heart stroke and has died. The family has gone into deep sorrow. Slowly, financial problems also started bothering them as they couldn't able to pay EMIs for their house and car. They were taken back by the bankers. One day, his wife remembered her husband bought a life insurance policy. Immediately, she approached life insurance company with relevant documents. Life insurance company helped them by paying 1 crore insurance coverage. So their house and their car came back and children started going to the same school happily. Like that, insurance company has saved their lives financially. Asset. An asset is a kind of property that yields value or a return. So we have got two kinds of assets, tangible assets and intangible assets. Tangible assets means we can see them physically. In case intangible assets, we can't see them physically, still they have got a value. So intangible assets, equipment, machinery, buildings, stocks, vehicle, land and cash. So we can see them. And in case of intangible assets, trademarks, patents, copyrights, licenses, goodwill, brand and franchises. So all these things comes under intangible assets. Insurance of assets. Insurance provides protection only against financial losses arising from the unexpected events. The insurer can only pay a sum of money which would reduce the economic impacts of the loss. As life insurance deals with humans, what are the risks faced by ordinary people? Dying too early, which is also called premature death, living with disability, and living too long, it is also a risk. How insurance works? Insurance is an agreement between insurer and insured. Here, insurer means insurance company and insured means the policyholder. One party pays premium, another to take responsibility to pay the sum of money to named beneficiaries on occurrence of the insurance events like death, disability and dismemberment. Financial planning. This chapter is very important because we may get more questions from this chapter. First of all, types of financial planning. Everyone has got three kinds of goals: short term goals, medium term goals and long term goals. Buying a LCD TV and family vacation comes under short term goals. Buying a house and vacation abroad comes under medium term goals. And children's marriage, child education and retirement planning, these kind of needs comes under long term goals. Every individual moves through various stages in the life cycle. The investment style also changes to keep pace with the risk profile. This is indicated below. The risk profile and investment style. If the risk profile is aggressive, then the investment style will be accumulation. If it is progressive, then it would be consideration. If the risk profile is secured, the investment style will be spending. If it is conservative, the investment style will be gifting. Elements of financial planning: investing, risk management, retirement planning, tax and estate planning, financing one's needs. Financial planning is not meant only for wealthy. Indeed, planning should ideally start one earns one's first salary. Life stages and priorities. There are 7 stages in a human life. The first one is learner, age between 20 to 25 years. Here, the priorities are fees for medical and management of education. Then earner, age between 25 onwards. One may save for the future needs that may arise in the immediate future. And the third stage of life is partner, that is between 28 to 30 years, planning for house and children's future, etc. And the parent, age between 28 to 35 years, planning for family's health and children's schooling. And the fifth stage of life, provider, age between 35 to 55 years, and making provisions for daughter's marriage and settlement of son or daughter's future. An empty nester, age between 55 to 65 years, healthcare, financial independence and security of income becomes very important at this stage. And seventh stage of life is retirement, the twilight, 60 plus, caring about one's health, vacations abroad, or pilgrimage and gifting to their loved ones. Role of financial planning. Financial planning is very much important for the current family system because disintegration of giant families, multiple investment choices, changing lifestyles, inflation, and other contingencies and needs. Financial planning is the process of carefully evaluating a client's current and future needs along with his or her risk profile and income to chart out a roadmap for meeting various anticipated unforeseen needs through recommending appropriate financial products. Let us see what are the financial products and what kind of segment they belong to. First one, transactional products, bank deposits and other saving instruments that enable one to have adequate purchasing power, liquidity at the right time and quantum. Second one, contingency products like insurance. These provides protection against large losses that may be suffered in the event of sudden unforeseen events. Wealth accumulation products, shares and high yielding bonds or real estate are example of such products. Here the investment is made with a view of committing money for making more money. Here, why should I go for a financial planning? A need to save for cash requirements, a need to insure against uncertainties, a need to investment for wealth creation. These 3 points are important. Human life value. Solomon Stephen Hubner was originated the concept human life value. Through this calculation, we can assess the value of a person. Value means the financial value of a person. Here I have taken an example. Name Bharat, occupation software engineer, and his annual income 5 lakhs. Assumes if the bank interest rate is 5%, Now calculate his human life value. Annual income, that is 5 lakhs into 100 by 5, that is 1 crore is Bharat's human life value. As discussed, if the bank gives 5% interest rate, his family will get 5 lakhs every year in case of Bharat's death. It is also called income replacement method. Life insurance products overview. Life insurance products offer protection against the loss of economic value. Life insurance provides peace of mind, provides living benefits like endowment, disability benefit, and dreaded disease cover. Rider provide a means to provide benefits like disability cover, accidental cover, and critical illness cover as additional benefits. Let me explain traditional life insurance product. First of all, term insurance plan. This plan valid only during a certain time period. This policy works as an income replacement plan. This policy covers only death benefit. The USP of this plan is its low premium. Three types of other variants also available: increasing coverage, decreasing coverage, and return of premium policies. And endowment assurance plan. It covers death and survival benefits both payable. It provides insurance and saving features, can provide long-term financial goals such as child's education and marriage. Whole life insurance plan. It is an example of a permanent life insurance policy, costlier than any other insurance product. They are called convertible life insurance products. Helps wealth to be passed to the next generation. There are three types of term insurance products. First one, pure term insurance. In this plan, if death happens any time during the term, death benefit is payable, but there is no maturity at the end. In case of return of premium policy, death benefit is payable any time during the term. At maturity, all premiums will be paid back if a person survived. In October 2020, IRDAI has introduced a standard individual term life insurance product called Saral Jeevan Bima. Saral Jeevan Bima shall be prefixed by all the insurers. And third type of term insurance plan is mortgage redemption insurance. It is also called decreasing term insurance. Usually, people taking loans like housing loan, personal loan, education loan can go for this mortgage redemption insurance. In this plan, premium is constant throughout the term, but sum assured keeps on reducing. Participating plans. The term par implies policies which are participating in the profits of the insurer. These are known as with profit plans. Endowment plan, money back plan, and whole life plan comes under participating plans. Non-participating plans. Policyholder who buys these plans will receive fixed and guaranteed benefits. These are known as without profit plans. Money back policy. The money back policy is a popular endowment plan in India. It has a provision for returning some part of the sum assured in installments during the term and the balance sum assured at the end of the term. Annuities and pension. Defined benefit plan where a fixed sum is paid regularly. Defined contribution plan under which a fixed sum is invested which becomes available at retirement age. Annuity and pension. There are two kinds of plans available in pension category. One is deferred annuity plan. Here premium is paid in installments and at the end pension starts at a specific period. Whereas in immediate annuity plan, premium is paid in lump sum and pension starts immediately. Non-traditional life insurance products. Universal insurance plans introduced in USA in 1979, flexibility in premium payment, death benefit and cash value of the policy fluctuates according to the investment performance of a special investment account into which premiums are credited. But we don't have universal insurance plans in India. Unit linked insurance introduced in UK during the 1960s provides opportunity for both insurance and investment. Flexible and transparent, unit value is evaluated on a net asset value. Choice of funds like equity, debt fund, balanced and money market funds. Saral Pension to provide uniformity across insurers. In January 2021, IRDAI mandated all life insurers to introduce a standard immediate annuity product with simple features. The product offer two annuity options as follows. Life annuity with 100% return of purchase price and joint life annuity with a provision of 100% annuity to the secondary annuitant on the death of the primary annuitant and return of 100% purchase price on death of last survivor. Mode of annuity payments would be monthly, quarterly, half yearly and yearly. Premium denotes the price that is paid by an insured for purchasing an insurance policy. The components of premiums: mortality rates, interest, expenses of management, reserves, and bonus loading. Types of reversionary bonuses. So, we have got four kinds of bonuses. One is terminal bonus, the second one is super compound bonus, the third one is compound bonus, and the fourth one is simple reversionary bonus. Let's see the components of policy document. Proposal stage documents: proposal form, age proof, address proof, agent confidential report, which is also called ACR, and medical examiner's report, moral hazard report. Agent confidential report and medical examiner's report should not contain the policy document. And policy stage documents. First, premium receipt. The FPR is the evidence that the policy contract has begun. Policy document consists of three parts. The first one is policy schedule. It is the first part. It is usually found on the face page of the policy. It has insurer's details, start date, end date, and mode and term, nomination details, etc. Part B, standard provisions. This contains rights and privileges and other conditions. Third part is specific policy provisions. This contains days of grace, non-forfeiture in case of lapse, etc. 1938 Insurance Act. Important sections. Section 38. Assignment. The act of transferring the rights, title and interest in the policy from one person to another. We have got two kinds of assignments. The first one is conditional assignment. The second one is absolute assignment. Section 39. Nomination. Nomination only gives the nominee the rights to receive the policy monies from the insurer in the event of the death of the life assured. If nominee is a minor, the policyholder needs to appoint an appointee. Section 42. Agent recruitment. This section talks about the eligibility of an agent. Citizens of India, major must have minimum 10th qualification, must complete pre-recruitment Test must carry license always. Next, section 45, which is called indisputability clause. If any misrepresentation made by policyholder and if insurer finds it is a misstatement, then the policy can be declared as null and void. Policy not to be called in question on grounds of misstatement after 3 years. Married Women Property Act. Section 6 of the Married Women's Property Act 1874 tries to ensure that the benefits under a life insurance policy will pass on in a secured manner to the wife and children through creation of a trust for the purpose of wife alone, wife and one or more children jointly, one or more children. Keyman insurance. Keyman insurance can be described as an insurance policy taken out by a business to compensate that the business for financial losses that would arise from the death or extended incapacity of an important member of the business. Keyman insurance is allowed as a term insurance policy where the sum assured is linked to the profitability of the company rather than the key person's own income. Risk classification. Standard lives. This means a normal risk or an average risk. Preferred risks. People having lower risk than the standard lives comes under preferred risks. Usually doctors comes under this preferred risk. These people will have a low premium rates. Substandard lives. People who has got physical deformity comes under substandard category. Usually these people will be charged more premium than the standard lives. Declined risks. If a policyholder involved in hazardous activities or a physically disabled can come under this declined lives. What is an insurance claim? Here, insurance is a financial agreement between insurer and an insured. Here, insured needs to pay a fixed premiums and in exchange the insurance provider offers financial cover for losses based on the policy terms and conditions. Usually we have got two kinds of claims. One is survival claim and the other one is death claim. What are the forms needs to be submitted for the claims? So here for the survival claim, policy document and KYC documents. In case of death claim, we need to submit claim form by nominee, certificate of burial or cremation, treatment physician's certificate, hospital certificate, employer certificate, death certificate issued by municipal authorities, first information report, FIR, inquest report, postmortem report in case of death due to accident. Section 3, Health Insurance. Health insurance is important because of the two reasons. The first one is providing financial assistance to pay the medical facilities in case of any illness. Second one is preserving the savings of an individual which may otherwise be wiped out due to the illness. Determinants of health: lifestyle factors, environmental factors, and genetic factors. Types of healthcare. We have got three types of healthcare. One is primary, the secondary, and the third one is tertiary. In the primary stage, a person visits a doctor for fever. The first diagnosis is indicative of dengue fever, and doctor may size some medication or hospitalization. At a country level, primary healthcare centers are set up both by government and private sectors. Secondary. This refers to the healthcare services provided by medical specialists and other healthcare professionals who generally do not have first contact with patient. It includes acute care requiring treatment for a short period for a serious illness. And the third one is tertiary. It's a specialized consultative healthcare, usually for inpatient, and refers from a primary or secondary care providers. For example, oncology, cancer treatment, and organ transplantation facilities, high risk pregnancy specialists, etc. Evolution of health insurance in India. Employee State Insurance Scheme started in 1948. Central government health schemes started in 1954. And commercial health insurance started in 1986. And Mediclaim, the first standard health insurance, started in 1986. Third party administrator, also called TPA. They are registered with IRDAI and servicing of claims by way of pre-authorization of cashless treatment, hospitalization due to personal accident policy and domestic travel policy. They also facilitate carrying out of pre-insurance medical examination for underwriting. Health insurance documentation. There are 5 parts in it. The first one is proposal form. The second one is prospectus. The third one is acceptance of the proposal, which is also called underwriting. The policy document and conditions and warranties. Classification of health insurance products. Hospitalization indemnity cover. They pay for actual medical expenses incurred due to hospitalization. Fixed benefit covers. They pay for a fixed sum per day for the period of hospitalization. Some products also pay for a pre-decided amount for different surgeries. Classification based on customer segments. Individual cover offered to retail customers and the family members. Group cover offers to corporate clients covering employees and groups covered their members. Master policy for the government schemes like Pradhan Mantri Jan Arogya Yojana, etc. Let us see various features of hospitalization indemnity cover. The first one is inpatient hospitalization expenses. This is for the people who stays in the hospital for more than 24 hours. And daycare procedures. So we have got around 150 daycare procedures where the patient need not to be stayed in the hospital for 24 hours. And OPD cover. Pre and post hospitalization expenses. Usually pre-hospitalization it is before 30 days of hospitalization, and for the post-hospitalization it is 60 days after the discharge. Doctor comes and visit at your home. That is called domiciliary hospitalization. Migration and base cover plus top up. Usually a policy consists of base cover. If you want, you can go for a top up. And family floater. You can add your family members into the policy. Self, spouse, parents, paternal parents and children, for altogether it is one single policy. What is a pre-existing disease? Diseases suffered by an insured person within 48 months prior to commencement of the policy are called as pre-existing diseases. In such cases, insurers are not allowed pre-existing diseases after 48 months of the commencement of the policy. What is Arogya Sanjeevani? In the background of the COVID-19 pandemic, IRDAI asked all insurance companies to come out with a standard health product called Arogya Sanjeevani with no variations in terms and conditions to make it easy to understand. Both individual and family floater plans are available under Arogya Sanjeevani. Health insurance underwriting. Purpose of underwriting is to prevent anti-selection and to classify risks. Age, habits, family history, past illnesses, environment, gender, occupation, build, and current health status. Health insurance claim process. First one, intimation, then registration, verification of documents, capturing billing information, coding of claims, process of claims, arriving at the final claim payable, payment of claim, managing of deficiency of documents or additional information required, denial of claim, suspect claim for more detailed information, managing of claim documents, and finally audit of claim. Before going to write the exam, 3 things you should remember. You should carry your hall ticket before going to write the exam, because hall ticket has got the exam language, exam timing, and your signature also. You need to check your signature. And be there in the exam hall 15 minutes before the exam time, so you will have relaxation before going to write the exam. And third one, there are 50 questions and you have got 60 minutes in time. So no need to hurry. So write all the 50 questions, because there is no negative marking at all. So whatever you guess, you put it the mark. See that all the 50 questions are answered. All the best. Have a bright career with insurance industry. Thank you.